Hello and good morning or good afternoon, depending on where you're dialing in from. My name is Mike Coburn. I'm a partner in the Fasken Vancouver office, and I'm joined today by Legault from our Montreal office, and we're going to go through a number of tax matters today. We've got a lot to cover, so we want to get right into it. We're going to look at some important changes in law, some tax-related deal trends that we've seen, and we're going to touch on some broader tax developments. If we could move to the next slide, yeah. We'll also, as you'll see on this slide, I do have a reference here to tax policy. Now, I put that there at the risk of having all but about 10 people log off the chat. But again, I can assure you we're going to talk only at a very high level. And we do want to touch on it because we do think there are some trends in the tax world that are going to have a significant impact on M&A, and we wanted to walk through those. We promised to use as little jargon as we can, and we'll ask you to hold us to that. I'll start the proceedings. I'm turning it over to Martine to talk about exchangeable shares.
Thanks, Mike. So we'll start today with a few comments on a pretty popular structure that was used in the recent years, which is popular in a sense because mostly of the economic context, but the exchangeable share structure. And Angela, please, if you can switch the slide. So the context underlying the exchangeable share structure it involves a situation where, for example, you have a Canadian shareholder that disposes of shares or an asset to a non-resident purchaser, and as part of the consideration being given to the Canadian vendor, there's a share component that relates to the shares of the non-resident purchaser. This is, as I said, common in the recent years because it was designed also to accommodate acquisition by non-resident purchaser. For example, in the context, recently there were a lot of transactions structured as in order to, for example, to go public in the U.S. So a U.S. SPAC was used in order to make the acquisition. For example, it's also the case for private equity players, venture capital players who want non-resident who want to make acquisition of Canada. In Canada, also for strategic buyers. So the real issue, if we're looking at the slide, is the situation if we compare the original scenario with the without an ESS situation where the Canadian shareholder receives shares directly from the non-resident, from the foreign co as part of the transfer. And basically, the main consequence that would result from this transfer would be an immediate taxation of the entire proceeds received by the Canadian shareholder. So basically, it's like if this shareholder would have received a cash proceeds rather than a share consideration. And the real issue with this is the fact that without receiving any cash, the shareholder or the vendor still has to fund the payment of taxes that relate to this transaction, which could be by itself an issue. What has been developed over time in the market or in the Canadian market is a potential relief that would allow the deferral of the Canadian tax upon the ultimate disposition of the share consideration being received. So rather, and when we're looking at the slide here, rather than receiving directly shares of the foreign co, so the entity directly owned by the non-resident shareholder, the Canadian vendor would rather receive shares of a Canadian entity that would be created specifically for this purposes. So it's kind of a special purpose vehicle being created solely to accommodate this transaction. And the benefit of this creation or this structure, intermediary step, is the fact that because it's a Canadian entity, it's possible to rely on some specific disposition of the Canadian Tax Act that would allow a deferral of the potential or the tax consequence that would otherwise have been triggered as part of the transfer directly to the non-resident shareholder. And it's also interesting to note that first, one of the condition, of course, is to receive shares of a Canadian company, a taxable Canadian company. That's one of the condition. But it's also possible to do it while transferring not only shares of another entity, of a target, but it could also apply in respect of assets such as an entire business. It could also be some specific assets, for example, a license or an asset having some significant value. So, but at the end of the day, when we're looking at the structure at the right of the slide, we see that the Canadian shareholders are holding shares of a Canadian entity, and the shares that they own will somehow track the value of the shares of the foreign company or the foreign co on the slide, meaning that it's kind of a tracking share that will have somehow the same legal and economic value as the ultimate shares of the company that would have otherwise have been received. And these shares owned in the Canadian entities would most likely be convertible into shares of foreign co upon a liquidity event. And this liquidity event could be, for example, if the company goes public or if there's a takeover or any other scenarios that could be covered by the liquidity event provision, such that it's only at that time in the future that the capital gain that was unrealized at the time of the first transfer would ultimately be realized. Of course, as you can appreciate or imagine, this structure is complex per se, so the implementation is key. You want to make sure that you don't get into some specific rules that could trigger not only an immediate taxation for the Canadian vendor, but could convert what would have been a capital gain into a regular business income or property income, which would be taxable at 100% tax rate versus inclusion rate, versus a 50% inclusion rate. That would be the impact for the vendor, but for the purchaser, which is ultimately the Canadian entity being created, there's some pitfalls that they need to consider. For example, they would inherit the low cost in the shares that had the Canadian vendors, such that if they want ultimately to unwind or dismantle the structure, there could be a cost associated to it. Even at the beginning, they wanted to accommodate the other party. There are some specific tax rules that could apply. For example, if we want to move cash in the structure, pay dividends, or want to attract some key employees and put in place a compensation regime, as we will see in the next slides, that would be applicable. So otherwise said, there could be a cost associated with the implementation of this structure. And normally this could give rise to some negotiations between the party, in which case this could impact, for example, the purchase price that would be associated with this transaction. I leave it now, Mike, you can go on the next slide.
Thanks, Martin. We're going to move to another important structuring consideration, and that has to do with what do you do with employee compensation plans. And the most common of these, of course, would be employee stock options, but I also do want to touch briefly on other plans as well. Before jumping into sort of transactional elements of stock options, though, we just wanted to remind everyone of a fairly important change that came in last year, but people still may be catching up on. And that has to do with a narrowing of some of the tax benefits associated with stock options. And what this arises from is that stock options, as many of you may know, when you exercise a stock option or you sell an option, you trigger an employment benefit as an employee, which is notionally taxable as ordinary income. But there is an ability to utilize a deduction, which we call the paragraph 1T1 deduction, 110(1)D deduction, which again, I promise not too much jargon, and that is one I can't avoid. And if you're eligible for that deduction, the employment benefit is reduced by 50%. So it creates a capital gains equivalent rate of tax for stock options. Obviously, this is a very important tax attribute or value for option holders. The Department of Finance a few years ago, I think, decided it was a bit too generous. So they've tried to narrow it down a little bit. So for certain corporations issue options after July 1st of last year, So again, this has been in place for a little while. There may be limits on the ability of option holders to access that deduction. So in terms of the companies that are impacted, at this time, you'd have to meet two tests. One, the company can't be a Canadian-controlled private corporation or a CCPC, and it has to have annual gross revenues that exceed $500 million in a year, or it's a member of a group that exceeds that amount. So fairly large companies to start with. What we'd be looking for here would be, the most obvious group would be public companies, but it would apply to a private company that is controlled by one or more non-residents of Canada and meets that revenue test. And so there can be some complications if you have a private company where perhaps a majority interest is held by a large U.S. fund or a large U.S. entity. So the rules may be a little bit broader than they look at first glance. And of course, we always worry that whenever there's a threshold amount, it's certainly easy for the government to expand the rules by just dropping that threshold amount. So that could be something to keep an eye on. If you do fall within these rules, there's a new cap on the ability to access the 110(1)B deduction. And that cap is based on you're only allowed to receive $200,000 in value options, in vested options in a year that would be eligible for that deduction. That value is based on the underlying value of the share at the time of vesting. So for instance, if you had a company that shares were worth $20 and they issued an option holder 30,000 options, they would exceed that threshold, and only a portion of the options. Sorry, if they issued 15,000 options at say $20, the value of those shares would be $300,000, and so only 2/3 of those options would be eligible for the 110(1)B deduction. Stock options granted before July 1st are grandfathered, so you don't have to worry about that. This is just a post-July 1st issue. In the context of M&A, where this could have an impact is, as many of you may have experienced, when you're buying out options or dealing with options in an M&A process, there's often an obligation to withhold tax. And when you're withholding tax, you factor in whether the options are eligible for 110(1)D. And so it used to be, if you kind of could undertake perhaps a simple exercise and say, well, everyone's eligible, we can base our withholding calculation on that. You now may have to take a closer look and figure out which of the options are eligible and which aren't. So that could create some issues. Stormy, I've just been asked, there's been some audio issues, so I've been asked to dial in. So if you could just give me 1 minute here.
So hopefully everyone can hear me a little bit better now. Apologies for that. So continuing on, again, we have these new rules. Now transitioning to the next slide, if we could, getting into the structuring element of it. Stock options can be complicated to deal with in the context of an M&A transaction. One of the first issues that arises is whether or not the options are going to be sold or whether they're going to roll over. Now, fortunately, the Tax Act, if they are going to be rolled over, has a pretty good provision that allows for a tax-free rollover. By pretty good, I mean the conditions are fairly easy to meet, it's simple, and it's pretty generous in saying there's really no tax event. But it is important to remember that that only applies for employee stock options. So if you've issued options to consultants or any other non-employees, you can't rely on that rollover provision, which creates a lot of complexity in a potential rollover. If there's ultimately a decision that rather than rolling over the options are going to be disposed of, then the next sort of part of the decision tree is, are we just going to buy out the options, or are we going to try to facilitate an exercise so that everyone is holding shares at the time of the deal closes? The probably starting point for a lot of deals is to say, well, it's probably just easier to buy them out. The issue with that is that under the technical rules of the Tax Act, if there is going to be a buyout of options, in order for the option holders to benefit from the 110(1)D deduction, it has to be the employer that buys out the options rather than the buyer. So you've created now a deal complexity where rather than the buyer just buying everything, they have to usually fund the company to buy out the options. And now you've got sort of two buyers. You've got the company who's buying out the option holders, and then you've got the buyer who's buying out the shareholders. And that can create real sort of challenges in your purchase agreement because, you know, are you going to have separate purchase agreements to reflect that? If not, how do you bring in the option holders to indemnities if you want to, and reps and warranties? the purchase price is notionally reduced because the purchase price for the shares is lower because this money is being funded into the company to buy out the options. So how does that impact your indemnity caps and other things? These are certainly not insurmountable challenges, and we do plenty of deals where options are bought out, but it does create some complexity. And out of that complexity, there's sometimes a desire to say, well, let's just make it simpler and have everyone exercise. And the issue with that is, well, then how do you make that happen? Because we generally assume that option holders are not going to be in a position to come up with the cash to exercise. So you're going to have to facilitate it, usually through a loan process. And generally my view is, that's fine. It's probably better if the loan comes from the buyer. I think there are certain risks associated with the company loaning money. And one of the issues that can pop up is I've been involved in transactions where buyers will agree to this, but they're very reluctant to sort of actually circulate the cash, even though it will make its way back to them because it goes into the company. And then when they acquire the company, they can just return the cash. They just, for cash flow purposes, would rather not do it. And so there's often tensions about, can we get this done just through directions and acknowledgements and not actually move some cash? My view is that is risky and creates a possible loss of the 110(1) deduction. So I generally try to push for at least the cash going into the company if you're going to do that exercise. Maybe moving on to the next slide. The other issue that can pop up that can be tricky with options is if your deal has an earnout or holdback element. And this just arises because the Tax Act is not very clear on how to deal with these things, and the Canada Revenue Agency isn't very generous. And so the CRA has said that if you sell an option for a cash payment and an entitlement to an earnout post-closing, you have to value that earnout in calculating your taxable benefit. So if you got $1 at cash at closing and some sort of entitlement, your total proceeds that you'd have to report for tax purposes would be $1 and the value of that earnout. Likewise, if there's a holdback, you have to include the amount of the holdback in your proceeds at closing. So that creates a couple of problems. One is, how does one value an earnout? And I don't think there's a good answer to that or a clear answer to that. So that creates a problem. And secondly, if you do value the earnout and you include an amount as your proceeds, or you include the holdback amount, there's no clear way in the Tax Act to recover the tax that you paid on those amounts if you subsequently don't get them. So if the earnout's not realized or the holdback isn't paid back to the shareholders, there's no clear way or even murky way of going back and saying, well, I paid too much tax to the extent that I pay tax on those things. So it's not a great situation for option holders. And again, there's no perfect answer for how to deal with that. I have seen deals where out of these complexities, the option holders were excluded from the earnout and excluded from the holdback. But obviously that's a business decision and there may be other issues that come with that. So moving on from options into another sort of area of tension in transactions from a tax perspective, and that is, if we can move to the next slide, before moving on to transaction expenses, I did want to touch briefly on other plans. So yeah, you can move to the next slide, that's fine. We do often focus on stock options because they're usually the most important plan, but it's important not to lose sight of other compensation plans. So for instance, if there's a restricted share unit plan or a deferred share unit plan. And the reason why it's important to be on top of those things is, unlike stock options, there aren't provisions in the Tax Act that nicely deal with rolling those plans over or allowing for them to be bought out. And in some cases, a buyout could be very negative in terms of DSUs. And so you often then have to, in the context of a deal, look to the terms of the agreement itself to see, does it contemplate this transaction? And if it does, is the outcome that the agreement contemplates consistent with what we want to do in the deal? If it's not, you may then be in a situation where you have to amend the plan or revise it. And in doing that, you always have to be aware of these very complicated and punitive salary deferral arrangement rules. So really, I think the takeaway here is, at an early stage of the process, you want to identify if any of these plans are there, and then figure out a path to dealing with them in the context of the transaction. So we can move now to the next slide, which is, again, transaction expenses, which is often, the reason we're talking about this today is because in your M&A process, you'll want to try to set up the payment of the transaction expenses in a way that is tax efficient. And so we've got a sort of a laundry list here of the various things that are considered transaction expenses for tax purposes. And it's a broad range of things, most of which you probably would expect, however. You can move on to the next slide. So there's kind of two tensions with transaction expenses in the tax world. One is there's a concern that if the target company pays the transaction expenses, or even if the buyer pays the transaction expenses, that might be seen as creating a shareholder benefit for the vending shareholders. And shareholder benefits are generally taxed in an adverse way. So that's the one issue. The second issue is, to the extent the company does pay them, are the expenses immediately deductible from income, which is a good thing because you can use them right away, or do they get added to the cost of property, which could be a bad thing in that you may never actually get to benefit from that expense if it's added to the cost of property. So those are sort of the two issues that, from a tax perspective, we worry about with transaction expenses. There's been a lot of litigation and CRA audits on transaction expense, and because of that, a decent amount of jurisprudence. The most relevant recent case was one, if we could move to the next slide, Rio Tinto Alcan, which was a federal court of appeal decision, which is the second highest level of court for tax matters. So a fairly important decision in that regard. And there's sort of two interesting things that came out of that decision, from my perspective at least. One is the court didn't talk at all about the shareholder benefit issue. And that's actually consistent with previous decisions and even the CRA's administrative positions. In my view, and I emphasize this is my view and others may not agree with it, I think in a situation where you have a fairly significant base of shareholders and option holders, so we're talking maybe more than 10 people, maybe even less than that in some circumstances, I think the risk of a shareholder benefit if the company or buyer pays the transaction expenses is quite low. And again, I base that on the lack of any discussion about shareholder benefits in Rio Tinto and other key cases on transaction expenses. What Rio Tinto did look at was this deductibility issue, whether they were currently deductible or had to be added to the cost of property. And the court in that basically created a concept of two different periods: an oversight period where all the expenses would be deductible, and then an execution period where all the expenses would be added to the cost of property. And in Rio Tinto, they broke those two periods up at the time that the board of the target approved the deal. And it's unfortunate they didn't spend a whole lot of time getting into why that was particularly the important sort of point in time. And I think some commentators have suggested that, if you're going to split these two periods up, there might be a better, in some circumstances, that might not be the best place. But in any event, we now live in a world where we do have, a certain period where the courts have said, yes, those expenses are deductible, and then another period when they're added to cost. So we do have a little guidance in that regard. So moving on to the next slide. I'll turn it back to you, Martin, to talk about Eiffel.
Thanks, Mike. So the next topic is a significant one because it's a major change in the Canadian landscape, at least in respect of in the transactional matters. So in the past, I could say the current state of the art is that in Canada, if a taxpayer contracts a borrowing, for example, and uses the funds in its operations or to purchase an asset that will somehow support generation of income, typically this would support the interest deductibility in Canada. So meaning that if you borrow from a bank in order to do an acquisition or to use it in a business, typically the Canadian borrower would be able to deduct the interest. Recently, in fact, based as per following budget 2021, the federal government, in fact, proposed legislation that would limit the deduction of interest in certain circumstances. And the rationale behind the potential introduction of these rules is to prevent the erosion of Canadian tax base. So by erosion of Canadian tax base, we can say that basically it encompasses the situation where, for example, in a context of a cross-border international tax group, there's some interest expense paid or suffered by a Canadian taxpayer. And the counterpart would be an interest income, for example, in the hands of a non-resident related party that is based in a low tax jurisdiction, or it could be a situation where a loan is contracted to invest in a foreign subsidiary, which will pay non-taxable dividend to the Canadian borrower, or also other situation where there's a shift of the interest expense or the indebtedness that is assumed disproportionately by the Canadian borrower. And these are the situations that basically should be captured by the application of these rules. We have to keep in mind that a few years ago, the OECD introduced some principles that support the application of this proposed legislation. And most of the G7 countries and also European Union countries have enacted rules that are similar to what we might have in Canada in the context of a cross-border financing. It's important to note that, as we will see later, that the limitations that would apply would somehow limit the deduction in excess of a fixed ratio of the tax EBITDA of the company. So, otherwise said, to the extent that you compute the tax EBITDA of the company, and this gives you the amount and the threshold of the interest expense that is being incurred by the company is in excess of this tax EBITDA, the excess would be denied and cannot be deducted in the current taxation year. As you can appreciate, this could have a significant impact on a lot of corporations, not only corporations on a standalone basis, but also as part of a corporate group. It's important to note that the threshold or the fixed ratio I was referring to would be of 40% in 2023 and would be reduced to 30% in 2024 to the extent that these rules are enacted. It's important to keep in mind that our first reaction would be to think that these rules should only apply in a context of a cross-border financing structure, because basically the rules that supported these rules were proposed in a cross-border context, in which case we would think that financing, internal financing, external borrowing with Canadian banks would not be captured by the application of these rules. And unfortunately, it will not be the case. And it's important to keep that in mind because it is not limited to transactions between parties, but it could also encompass situation where you have internal financing with Canadian banks. So the tax EBITDA is a calculation that is, I wouldn't say exactly the same, but could be similar to the EBITDA that we compute for accounting purposes, but subject to specific adjustments that are made to take into account the calculation of the tax income. The rules, in a sense, are subject to specific exceptions. For example, transactions between related Canadian entities should not be captured by these rules, such that if we put in place a loss monetization structure between Canadian entities, the limitation will not apply in respect of these transactions. Also, Canadian corporations that qualify as Canadian controlled private corporation with taxable capital, which means, in a sense, the capital being issued of less than $15 million will not be subject to the application of these rules. And also a group of corporations having a net interest expense of less than $250,000 will not be subject. So of course you appreciate or understand the fact that these exclusions are narrow, such that practically, when we talk about larger corporations, that will be subject to the application of these rules. What about the excess? Because I mentioned earlier that to the extent that the threshold is reached, there's a denial of the excess. There's some flexibility or the possibility under the proposed legislation to carry back or carry forward the unused excess to past or future taxation years. So that's a possibility for the taxpayer. The other possibility would be to be able to transfer the unused capacity to other Canadian members of the group. So this is a possibility that applies as well. It's important to keep in mind that the transfer of the excess to other Canadian entities is not possible for financial institutions because there are some limitations that apply specifically to Canadian financial institutions such as banks or insurance company. So basically, at the end of the day, of course, we didn't get into too much detail, but it's important to keep in mind that if these rules are to be enacted and become effective starting January 1st, 2023, this would have a significant impact on the financing of transactions because, of course, the possibility to trigger, to deduct the expense in the current taxation year might be limited or subject to significant considerations. Next slide. Okay, earnout. So another consideration that relates to the structure, which has been popular in the recent year, is earnout consideration paid by a purchaser to a vendor. And earnout per se is an agreement. It applies in a situation where there's no agreement between the parties in respect of the value of the business or the underlying goodwill. So meaning that the parties, because there's some uncertainty in respect of determining or valuing these particular assets, will put in place a structure to reflect the potential fluctuation of the value over a specific period of time. And this is pretty common, and this has been pretty common in the recent years, considering the economic uncertain environment we're living in. For example, as a result of COVID-19, the expected economic downturn at the beginning of the crisis, the war in Ukraine, everything that takes place in Taiwan. So basically, in order to deal with this uncertainty, the earnout structure was popular to compensate this aspect. For tax purposes, it's important to understand that the earnout component per se would generally be viewed as triggering regular business income or property income for the vendor, so fully taxable versus a capital gain. There's a specific provision under the Tax Act that applies in respect of this. And it's taxable on a cash basis, meaning that if the earnout is applicable on a certain or on the various years, every time that there's going to be a payment received, a cash payment received, it is at that time that the income inclusion will take place. Administratively, the Canada Revenue Agency has accepted that an earnout component could trigger a capital gain if specific conditions are met. And it's not a purpose of this presentation to get into the conditions, but basically, if you have parties dealing at arm's length and the transaction is capital in nature and there's a true contingency attached to the earnout between a 5-year window period, the concession might apply, and this could end up having a capital gain treatment at each time that there's an amount that is being received. So it could be a really favorable regime to the extent that the conditions are met, but the risk is in respect of the respect of the applications that could give rise to this concession. Next slide. So as for the reverse earnout, because the uncertainty in respect of the treatment of the earnout for this as part of a transaction has led the players in the market to structure deals differently, so by way of a reverse earnout. And I think by definition, you will understand that the reverse earnout is a consideration that is being structured as having the benefit of the maximum amount at the beginning from the get-go, So you go to I think you consider what would be the potentially the maximum amount to be paid or the most value you could get of it. And there's a reduction that would apply if certain milestones are not achieved or met over time in the future. So it's similar to an earnout, but you structure it the other way around. And in the past, the Canada Revenue Agency has confirmed that, in a sense, a reverse earnout, to the extent that we have a maximal amount that is subject to a reduction, would most likely give rise to a capital gain treatment. So you have certainty on the capital gain treatment, but there's an inclusion in income or capital gain treatment to be recognized at the beginning from the get-go versus an earnout, typical or classical earnout, which is subject to taxation over time. But it's a trade-off between the uncertainty versus the potential of differing part of the gain in a few taxation years. Recently, there's a court case that was rendered by the Tax Court of Canada that puts some tension or pressure about how you interpret the validity of a reverse earnout in a transactional context. Because normally a reverse earnout would be structured by a portion which will be paid upfront, which represent the certainty or the certain portion, and the uncertain portion will be subject to the issuance of a promissory note that would be set off over time if the conditions are not met, or would be repaid if the conditions are met. But this court case, so otherwise said, you don't want to sit necessarily to have a cash payment to be made upfront, because this will require funding by the buyer, which is not necessarily the desired outcome, because the buyer don't want necessarily to fund the contingency. This court case somehow puts some pressure, because there's a risk that in situations where there's no cash payment to be paid upfront, the court in the circumstances concluded, based on specific facts that were not necessarily good facts, but there's uncertainty as to whether a reverse earnout that is subject to a promissory note issued rather than a cash payment could qualify as a valid reverse earnout, giving rise to capital gain treatment. So that we're still looking at it, but clearly there's some uncertainty in the Canadian M&A tax space in respect of the treatment of reverse earnout. Next slide. So now we're getting into the second portion of the presentation that focuses more on the interaction between the interplay between the tax aspect of a transaction and how you integrate this in the legal documentation. So we will focus mostly on the tax indemnity, tax covenant, and also tax reps and warranties. And Mike will also thereafter talk about the insurance coverage for the reps and warranties. So if we start with the tax indemnity, I think generally speaking, the tax indemnity is in place to provide some protection about unexpected tax liabilities that relate to a pre-closing period. What do we mean by pre-closing period? I think generally speaking, this would cover, for example, normally an asset, a share transaction where all of the shares are transferred to one shareholder or one buyer, would trigger a deem year end, such that for tax purposes, you have a cutoff where all of you would have to file a tax return immediately before that time, such that there's a cutoff that will determine exactly prior to that time what is the tax exposure if there's a liability that is to apply. So that's it's not simple, but it's easier to determine. In respect of special taxes such as GST, QST, indirect tax, land transfer tax, or even some specific payroll taxes, you don't have a clear cutoff, such that we introduced a concept of straddle period that will determine artificially what's the cutoff that would apply. And it's before this specific cutoff, this would be subject to indemnification. And after that cutoff, it won't be. So that's basically how the tax indemnity provision is structured as part of a SPA. Now, I think it's important also to keep in mind that the tax indemnity may be subject to some specific rules or limitations. For example, there could be a cap or a maximum amount to be paid under the indemnity for the tax, not only the tax aspects, but also the other elements that are being covered as part of the transaction. There could be some basket where you need to aggregate some losses and reach a certain threshold before being able to make a claim. There's some limitation periods, meaning that under the Tax Act, there's a period under which you can make this, the tax authorities can claim against the company. So here it's going to be the same. You want to reflect this as part of the indemnity to make sure that it is aligned with this statute limitation period. And there could be also some exclusions. I think the point that we will see in the next few slides is the fact that the general indemnity for tax liabilities, the tax liabilities that will relate to a pre-closing period, are different or do not trigger the application of the same principle as for the reps and warranties. And it's something that we will look in detail in the next slides. But generally speaking about the tax indemnity, a few points I want to bring to your attention. There's more and more, it's more and more common to have some concerns on how you apply tax indemnity for reputational risk, because it's becoming more and more common, not only for governance purposes, but also with respect to the application of specific tax rules, example, aggressive tax plannings, GAR, etc. It's also more and more common to have specific tax indemnity that would apply with respect to some specific risks that were identified. So it's no longer, in some cases, the reps and warranties that will govern the treatment for these risks, but there's going to be a specific indemnity that will cover this risk. So clearly it's something to consider. And the reason why is that if you identify it, maybe there's a way to get around the cap or the survival rules I was referring to, which normally would apply systematically for reps and warranties, while it's not necessarily the case for the general indemnity. Also, the indemnity could cover some specific tax risk that will materialize over the closing of the transaction. If we talk about now the tax covenants, pretty quickly, in fact, I think it's important the covenant will in fact dictate things to do or things not to do. This could encompass, for example, the filing of tax returns, the filing of specific tax positions, could also be in respect of tax elections to be filed that result from pre-closing reorganization or for the previous taxation years. And it could also encompass some specific calculation or the disclosures that will have to be made as a result of the transaction. Next slide. Now, if we talk about I want to talk about the tax reps and warranties. I think in the recent years we've seen more and more M&A deals where the tax reps and warranties were purchaser-friendly provisions, such that they were more in favor of the purchaser than to the buyers. So, for example, there's a trend in the market about specific tax and warranties. For example, the SUS or governmental programs that were released as part of the COVID-19. We've seen confirmation of tax attributes is becoming more and more popular, which is hard to provide because it requires the analysis for the life of the entity, which is sometimes difficult to get. Also, for pre-closing tax reserves, there are some representations that are becoming more and more common. And we've seen in the recent years, as we will see later in the presentation, representations focusing on mandatory or voluntary disclosures and also non-application of the general anti-avoidance rules. So it's a trend that we see. I think at this point, it's important to keep in mind, as I mentioned earlier, that even if the reps and warranties could capture or target specific identified risk. They're not necessarily the tool that will be used to get indemnified, and we can get to the next slide. Because somehow there's kind of a duplication with the tax or the general tax indemnity, because most of the tax and reps and warranties will be covered by the pre-closing period liability that I talked about earlier. A few exceptions that could apply, but the general principle is that the pre-closing period liabilities will most likely cover these risks. So the preferred basis to get indemnified would most likely be the general indemnity versus the tax and warranties indemnity. But in any case, the reps and warranties are still common in the market for probably because they have also other objectives. For example, they can lead the vendor to focus on specific potential risk as part of a due diligence. So it's an important consideration. And also when there are transactions that are signed and closed later, there could be some walkaway rights or provisions that will allow the purchaser to walk away if it identifies a risk that is covered by the reps and warranties in order to either terminate or renegotiate the purchase price in respect of the deal. Next slide, and it's now your turn, Mike.
Thanks, Martin. Insurance coverage. I'm going to skip over this, I think, just in the sake of time. But what I would say, part of the reason we just want to emphasize is, part of the theme, I think, today is that tax is getting increasingly complex. And Martin's talked about the interest deductibility. I'll touch on a couple of things in a moment. And it's just, I think, increasingly, the due diligence challenges and the risks associated with tax are growing. And I think reps and warranties insurance is something that parties are increasingly going to look at to deal with that risk. And as Martin said, it may be the case of it's not going to be enough to cover just reps and warranties because there could be separate tax indemnities. So making sure that your insurance policy is crafted to appropriately address the tax risks in play. But if we could jump ahead a couple of slides to, the mandatory disclosure rules, which is an example of, where insurance might be useful. So these rules were announced earlier this year and were supposed to be effective earlier this year, but due to significant pushback from the tax community, they've been postponed, but only till January 1st, 2023. And the general consensus in the tax community is we're not likely going to see another extension. So this is going to be the world that we live in come January. And what these rules are is they're not new, but they've been significantly overhauled. So there's been for a while in the Tax Act rules that say if you undertake certain transactions, you have to file a report with the CRA. And the report sets out, details of the transaction, who was involved, what the transaction was all about. In the past, however, these rules were largely limited to what I might generally describe as tax shelter transactions. So a transaction where clearly what someone was trying to do, the main purpose, maybe the only purpose of the transaction, was to affect a tax savings. The government announced earlier this year an expansion of these rules, and this is a significant expansion. And, the language is a bit challenging, and I think there are still people working through kind of exactly what it means. But in my view, which I think is shared by most people I've talked with on this, if you have a transaction where there is any step that is there solely for the purposes of reducing tax, and there's a indemnity that protects someone from any negative consequences that might arise from that tax planning step, you're in these rules. So, I'd say in the last year, a majority of the deals that I've worked on would fall within the reportable transactions because, the sellers were undertaking some sort of tax planning as part of the deal, and they were providing indemnities to the buyer saying that if anything went wrong with that tax planning, they would make the buyer whole. And again, I think the general consensus is with those two facts, you're in these rules. If you're in these rules, you have to file a report with the government. And again, one of the changes, and it's a bit of a head scratcher, is it used to be that one report was filed for everyone. Just a single report was filed with the government. Under the amended rules, each party that falls within the rules has to file a separate report. And those parties will generally be anyone who benefits from the tax savings, anyone who benefits from the indemnity, and their respective advisors. So in a typical deal structure that I talked about, we would anticipate that on a strict reading of the rules, all of the sellers who benefited from the tax planning would have to file a separate report. The buyer would have to file a separate report. Their advisors, so their accountants, and I think most people feel their lawyers would also have to file separate reports. If any one of these parties that's required to not file, that is required to file a report, doesn't, then you're offside, and everyone's offside. And what that means effectively is that there are penalties, which can be significant. Under the old rules, advisors, the maximum penalty was their fees. That's no longer the case. There is an extended period that the CRA can challenge the transaction, so you're not going to get statute barred. And to the extent that the CRA wants to assess GAR against your transaction, the general anti-avoidance rule, certain defenses that you would usually have, important defenses, really the only defenses that you would have to a GAR challenge, you're no longer allowed to use. So effectively, GAR, for all intents and purposes, will be applied. So really significant negative consequences and pretty significant compliance requirements. And again, the rules, significant pushback from the tax community. They may be revised somewhat, we hope so, but I don't think we're holding out for wholesale changes. So, again, starting January 1, I think the takeaway for this crowd is that, as part of an M&A transaction, it's important to identify at an early stage, do we have a reportable transaction? Do we have those elements that would trigger this? And if you do, integrating into the deal a process for complying with this. So covenants to file these reports, perhaps a dispute resolution process if the parties can't agree whether the rules apply. We're still sort of working through what that will involve. But I think this is going to be a significant burden if the rules go forward as proposed. And I guess in some ways, the precedent for this is in Quebec, and I'll turn it back to Martine to talk about existing rules in Quebec.
And thanks, Mike. In fact, as you were mentioning, in the 2019-2020 budget, the Quebec government introduced similar rules applicable for the Quebec in Quebec, following the scandals and the corruption that took place in the construction sector. But generally speaking, the rules are similar to what we have under proposed federal rules, subject to specific exceptions. Maybe one of them is the disclosure of nominee agreements, which is now required, which is significant because if not done, this could result in the application of some penalties, and also no prescription period would apply in respect of the particular transaction subject to the nominee agreement. That's one important piece. And a significant one also that would have to be considered is to the extent that there's the application of penalty under GAR, the general anti-avoidance rules, or if there was a sham transaction, but I don't want to get into this one, but GAR is probably the most sensitive one. If there's a positive assessment under the GAR and the application of the penalty, there could be another consequence, which would be the impossibility to contract with the Quebec government or Quebec public bodies for a 5-year period. By public bodies, we target here not only the government per se, but also the crown corporations and also other kind of governmental entities, such as you can appreciate. It covers, it's a broad scope of application. And the real issue is that in certain circumstances, the tax benefit associated with the transaction that could be subject to the application of the general anti-avoidance rules are maybe limited versus the potential consequence of not being able to contract with the Quebec public bodies for a 5-year period. So the question then is, as part of the transaction, what kind of protection can you get to be protected if you're a purchaser? Could it be through the Reps and Warranties? Could it be to a specific indemnity? It's complex, and there's still clearly uncertainty as how to deal with this particular issue. We have to keep in mind also that there could be a due diligence defense that would apply if, for example, a tax opinion was obtained in respect of the transaction. But in this case as well, there's uncertainty as to whether the due diligence defense could include a tax opinion obtained from a law firm or an accounting firm as being a valid defense. So next slide.
think we can move ahead, to GAR. I think we're now at, if you keep going there. And yeah, I'm going to touch just very briefly on GAR, the General Anti-Avoidance Rule. Really the point here is earlier this year, the Department of Finance came out and said, we don't think GAR is working. We're applying it too much, which means it's not scary enough. And so they're talking about revising it to make it scarier, including adding penalties to it, limiting your defenses, et cetera. It's a very involved discussion that's ongoing with the CRA, but I think it is clear that GAR is going to be revised and it's going to be made scarier. The purpose we want to raise this in this call is, Martine indicated earlier, currently you do see bleeding into agreements, reps around GAR. We push back on those now. We think it's problematic to try to give comfort on GAR. It's going to get even more problematic to get comfort on GAR. And again, it's probably another reason why, given the uncertainty that may arise from, an expansion of GAR, to look towards insurance as a possible way of mitigating the risk. So this is very much a stay tuned. You'll get bulletins from us, no doubt. Please read them. At some point, this is going to be actual changes that we can talk about, but there's definitely something coming here and it's going to have a big impact. Similar on the next slide, just 1 minute on what is generally regarded as a series of international changes that are taking place that, tax doesn't make the newspaper that often, but this is an area where it does tend to make the newspapers, and that's around what might collectively be called base erosion and profit shifting, which is a bunch of measures that are being looked at and considered at an international level, led by the OECD, that are meant to address perceived inequalities in taxation. And so a couple of things you may have heard of is the proposal that there be a minimum global tax rate, currently suggested to be 15%. There's talk about moving the model of taxation, which is currently primarily based on where you're physically located, to a model that for at least some industries is based on where your revenue is generated. Also, very much a movement for increased transparency and the idea of having to disclose, countries forcing their citizens to disclose additional information that is then shared in real time with other countries. All of these things are moving along, and what's interesting is they move along somewhat slowly, but Canada has been an enthusiastic supporter of these provisions and has adopted some of them domestically, even before they were implemented sort of at international level. So this is not limited necessarily to the international sphere. We're seeing this domestically as well, and I think that will continue. And all of these things, I think it's safe to say, involve significant compliance requirements and significant penalties if you don't meet those compliance requirements. So again, in an M&A context, the tax analysis of the due diligence, along with the reps and warranties, the need for insurance, I think it's all going to be impacted by this growing complexity. And again, one of the interesting things of this is, as a simple example, we traditionally in the M&A context, we focus on, did it fail to pay any tax? Does it owe any tax? Again, it may be a case that it's fine on its taxes, but due to non-compliance, it's subject to significant penalties and other exposures. So the exposure is expanding from strictly, did you pay your tax, but to did you pay your tax and did you properly comply with all of these new initiatives? So again, just something to keep an eye on as it evolves. And I'll turn it over to you, Martine, to wrap up.
So maybe a quick comment on the recent legislation that was enacted in Quebec about the translation or to the dealing with the Quebec government in French. So for basically all going forward, various dealings with the government will have to be made in French, and this includes dealing with the tax authorities or other similar departments. So this could include, for example, contracts, settlements that are being reached with the Quebec government. It could also include some contracts in respect of incentives to be obtained from the Quebec or other agencies in the Quebec government. At this point, the procedures that are in front of a court are, it's unclear if they're going to be subject to the application of this rule, but it's still moving, and it's going to be interesting in the next few months to better see how it evolves. But the point here is that if a company is doing business in Quebec, even if it's a limited presence, these rules could apply and have to be considered. So now if we go to the conclusion before getting to some of the specific questions, I think what we tried to do as part of this presentation was to provide some general comments on the trends in the recent trends in the M&A space. So, for example, 2021 was an active market in Canada. A lot of uncertainty 2020 because of the COVID, but we were expecting a distress M&A market, but the reality was different. Now it's going to be interesting this year to see what kind of transactions will take place and if it's going to be as busy as it could have been in the past 2 years. But as we mentioned, it was pretty common in the past years to see exchangeable share structures such that you better understand that if the non-resident purchaser is in place, this could be a useful tool to use. We have to be careful with the application of the new option rules that could have a significant impact on how we compensate the key executive on a going forward basis as part of a transaction. The interest limitation, deductibility limitation rules would also have a significant impact on how we finance the acquisition of as part of a transaction. So we're going to stay posted because the outcome and how these rules are going to be interpreted and applied is still uncertain. And clearly we have to keep in mind that they apply not only in respect of a cross-border financing, but also when an external borrowing with a Canadian bank is involved, these rules could apply. And maybe the last point I want to mention, the last few minutes of this presentation, we talked about various tax policy regimes that could have an impact on corporate governance. For example, how we apply GAR, how we apply the BEPS rules in the cross-border context, the disclosure rules that could have a significant impact on compliance, reporting, but also possibility not being able to contract with the Quebec government, for instance, could have a significant impact on how we're going to structure some transactions. So hopefully these general comments were helpful. Of course, we were happy to answer some of your questions. And if you don't mind, I'm going to take the list I have in front of me and try to either answer myself or have Mike provide some comments when it's more the part that he covered. So the first one was about can CO's exchangeable shares be considered foreign property for Canadian foreign reporting purposes under Form T1135? So on this one, of course, I didn't do the research for the purpose of this presentation, but the way I understand the rules, the fact that you have a right to convert the Canadian shares into shares of a non-resident entity should be sufficient to make them a specified foreign property for the application of these rules. The second question, and this one is for you, Mike. I think it says, in the budget, the government announced its intention to bring in new rules relating to employee share ownership plan. Have any details relating to these new rules been circulated?
Yeah, not to my knowledge, Martin. I don't think so. And I think, again, just as background, I think that the way the government presented those is kind of an opportunity to increase sort of democracy in corporations by having employees sort of pool their shares for voting purposes. And I don't think it's primarily tax driven, but obviously it'll have tax implications. And I think given the complexity of trying to achieve what I think is a policy goal while, not creating tax problems means it's probably going to be a while before we see anything too specific on that.
Great. The next question, in fact, is they're asking, there was an increasing trend of individuals wanting to personally borrow to acquire an enterprise, small to medium-sized businesses. So the question is, was there tax rules that changed in the past couple of years that support this trend, or any comments about why this might be gaining popularity? Personally, I don't hesitate to jump in, Mike, but I think there's no specific rules that resulted in this. Of course, there were some. I think it's more a market it's more in relation to the market and the fact that there were some opportunities, transfer of businesses to either the next generation or to third party, or the fact that there were some strategic buyers or the private equity players or venture capitalist player that were interested in buying these business. But from my perspective, it's not necessarily in line or aligned with specific tax rules that were enacted.
Yeah, I'd agree with that. I think it's just cheap interest, right?
Yeah. This one is, okay, may you please give us some pros and cons on the evolving practice of having target paid transaction expenses, but not deduct them with a corresponding reduction in purchase price?
Yeah, I would say this one, this is, if someone has a half an hour, I'd be happy to talk to them. This is one I feel quite strongly about, but I don't know if we have time. The short thing I just say is I think there's no cons to that, in my view. And the pro is I think it simplifies the process considerably. And what I boil down to there is, especially in a widely held transaction, if you say to a shareholder, well, you know, the alternative is they're supposed to directly pick up their share of the transaction expenses, I think it's just a legal fiction, because, you know, if you sort of say to them, okay, well, you start out with $1 a share, but you've got to pay, you know, 3 cents towards Fasken's fees on this deal. You know, a lot of these people will be like, well, who is Fasken? I don't know anything about them, right? I'm just a shareholder here that doesn't know what's going on. And so I just think it's confusing to shareholders in widely held situations to expect them to sort of report directly transaction expenses that they had absolutely no role in or involvement in incurring. So, but again, I'm already starting a tirade there, and I'd be happy to talk to someone about that. But yeah, the short of it is I see no cons, and pros is I think it's simpler and more accurate of what actually has happened.
And maybe if I can add that, I think it's an easy area where the tax authorities could perform a tax audit. And based on the past experience, I've seen a lot of situations where tax authorities were challenging the treatment of transaction expenses in order to get some concession on other aspects of a transaction. But this is clearly an area where they could easily challenge a position that was taken because it's highly factual.
Yeah, I think on that too, just to clarify, Bart, I think most of those transactions, kind of go after the deductibility, right? And I think if the kind of assumption is there's not going to be a deduction there, I think that should mitigate a lot of the risk.
Agreed. So I think these were the questions that were asked in the Q&A. So on our side, I think we covered pretty much what we wanted to cover. Took few minutes more, but in a sense, we were able to cover all of the material. So thank you very much for your time and presence today. Hopefully this answers some of your questions, or at least enlightens you on some of the trends in the market, and happy to answer some of your additional questions if you have some. Thank you very much and have a great day.